Hi traders, I'm Lance Beggs from yourtradingcoach.com. What I'd like to do in this very short video is give you an overview looking at the strategic level of how I trade my favourite setup, which will be the one referred to in most of the analysis on my website. We're talking the big picture. Too many people make a critical error in focusing exclusively on their entry triggers and trying to enter on every occurrence of that signal, without any consideration for where that trigger is occurring within the bigger picture market structure. The fact is, market structure tells you where to trade. Triggers tell you when to get in and when to get out of your trades. Let's say, for example, that our trigger is a candlestick reversal pattern, in this case a bullish engulfing candle. And the market is currently operating within a trading range or a consolidation between very solid support level here and a very solid resistance level here. Where would you find the higher probability trade? Would it be at position 1 here, where the bullish engulfing pattern is pushing straight up into overhead resistance? Or is the higher probability trade here at position 2, where the support level is held and there is a significant profit potential still available from the entry point to a projected target at the overhead resistance level? It's exactly the same trigger, but obviously the market structure tells us that entry 2 is the higher probability trade. Remember, the market structure, in this case support and resistance, tells you where you should trade. The trigger tells you when to get in and out. Now, market structure doesn't need to be just support and resistance. You need to consider, what is the reality of price action as you see it? What do you believe causes price to move? Look at a number of charts. What do you see? Is it perhaps a framework of support and resistance levels, defining areas of price stall or reversal in the market? Do you see a rubber band type concept, with the market reaching extreme points and then reverting to the mean or centerline moving average, moving back and forward between the upper channel line, center line and lower channel line? Do you see swings, higher highs and higher lows, lower highs and lower lows, with impulses of momentum in between? Define how you see the bigger picture of market movement. What is it that you see when you look at charts? What is the market structure? And only then should you look for an entry trigger that gives you a low risk and high probability trade within the context of your bigger picture. So where does that leave you? Let's look at another example. Please note, this is not my strategy. We'll get to that soon. This is just an example of the concept. Say that you've looked at a significant number of charts, and what makes sense to you is reversals at extremes. You might define those extreme points by Bollinger Bands, Keltner channels, a moving average channel, or whatever. It doesn't matter. And you choose a trigger. It might be a moving average crossover, on a lower time frame perhaps, a candlestick pattern, or an oscillator cross. Once again, it doesn't really matter. However, what you have now is an entry signal that is occurring at a higher probability position by only taking entries at places of extreme price movement. In the example here, we've identified a range-bound market with a very slight uptrending bias. We might define our extreme points as being price at the lower band, here, with a corresponding oversold signal on the oscillator, down below this line here, and the trigger being the oscillator cross. So in this example, we're going long the range-bound market at the oversold position on the indicator here, which coincides with price in the vicinity of the lower band here. That is, at a potential extreme point with significant profit potential up to the center average or the opposite band. We do not take the oscillator cross long here, where the momentum is not retraced and the price is in fact already above the upper band. The occurrence of our trigger here does not define a trade. Our market structure defines where we'll trade. Only then we will look for a trigger. So we pass on that trigger, on that signal, and wait instead for the next trigger. Once again at an extreme low with an oversold oscillator and significant profit potential to the upper channel line. Market structure tells you where to trade. The triggers tell you where to get in and when to get out of your trades. Look at the big picture, define how you see the market structure, and then find the areas of high probability or low risk trades within that market structure. Don't just blindly follow your signals, filter them based on the structure of the market. And please do not just slap any number of indicators on the chart for no reason other than they have a cool sounding name and then try to work out how to trade it. It doesn't work that way. Define the big picture, reality of price movement first, and then find your entry. So what do I see as the reality of price movement? How do I trade? Well, you'll have to go to video 2 for that one. If you're not on my website already, then please go there, www.yourtradingcoach.com. You'll find the second video just over here on the right hand side. Video number 2. And in that short video, I'll introduce you to exactly how I define my market structure and also provide my favourite trade setup, which is used in the bulk of the market analysis that you'll find conducted on my website. While my focus is primarily day trading Forex and equity index CFD markets, this setup will in fact work on any sufficiently liquid market on any time frame. And while you're there, please go to the top left and enter your details just here to subscribe to the email and video newsletter so you don't miss any of our future yourtradingcoach.com analysis, articles or videos. And seriously, check out the disclaimer page via this button here. If you're new to trading, it is very hard. Don't believe the hype provided by much of the trading education industry. Trading mastery will take a significant amount of your time and will place at risk a lot of your hard-earned capital. So on that great note, I'm Lance Beggs, wishing you happy trading. Now go and get part 2 of the video.